Good afternoon, everybody, and welcome to our Anchor Diversified webinar. My name is Dale Franklin. I'm the Executive Director and Co-Founder of Anchor Financial Services. It's a very great pleasure of mine to introduce the Anchor Diversified product range. As you can see, Eskom has just decided to go off. So, there we go, back up again. So this is a wonderful collaboration between Anchor Asset Management and Anchor's multi-management business Nest. This Anchor Diversified has largely been an institutional retirement fund product and has a far greater view of risk management as it's been an institutional product. After running it for the last 6 or 7 years, we've decided to bring it to the retail space. It's a wonderful product range. Today we have speaking Mike Gresty, who heads local equity for Anchor, Nolan Wapenaar, who's Co-CIO and heads fixed income, and Simon Plooy, who's the Chief Investment Officer of Nest. So without delay, I'd like to hand over to Mike. Before I do, one quick one. If you do have questions, please put them into the question functions and we'll address as many of them as we can towards the end of the webinar. Thank you, and over to you, Mike.
Thank you very much, Dale, and good afternoon, everybody. If you'll just bear with me while I get my presentation up. Great, there we go. So yes, thank you. Good afternoon, everybody. I'm just going to spend a couple of minutes up front just familiarizing you with the SA equity product, and then I'll be handing over to Nolan and Simon, as Dale said. So just getting straight on into it. First of all, up front, what is the philosophy around which we're investing in South Africa? Yeah, make money for investors responsibly. I suppose that goes without saying, but I particularly want to focus on the point about doing so responsibly. You know, we operate in a South African market, which I would regard as a relatively stale one. We've seen more delistings each year over the last 15 years than we've seen new listings. So, as I say, it presents its own challenges, and as many of you will be aware, the very high level of cyclicality, given the resources bias, for example, means that when you approach this market, you need to be very considered, I believe, in exactly what your strategy is and how you're going to approach it. So what we want this fund to be known for is its very strong quality bias. I'll come to just exactly what we mean by that just now. But in truth, we find it very difficult to find enough shares that truly tick our quality box to enable us to build a diversified portfolio focused purely on those, particularly given South Africa's relatively muted economic growth as well. And some of the points I made earlier, you know, we think you need to be nimble, thoughtful, and constantly on the lookout for new special opportunities to augment that return. And that'll come from a whole range of sources. Maybe it's small caps, maybe it's value unlocks, certainly cyclical themes that are going to work from time to time. You know, we spend a lot of our time ensuring that we're correctly exposed to those to benefit from them, but remaining nimble enough to acknowledge that they're not going to work through all of time. So the main thing, the kind of golden thread, if you like, through our portfolio is that long-term holding of quality compounders. Now, when we look particularly at the quality compounding component, first of all, just cast your eyes over to the right there. In terms of the shares that we would regard as ticking that box, I've listed a number of them. I know it's always likely to be a bit controversial because everyone has their own views as to what they regard as quality and not. You know, for us, what does it mean? It really does mean companies that are active. You know, I think if you don't continue to invest capital in an ever-changing world, and adapt with that, you die. So we're not looking for companies that are necessarily just generating high returns and passing that back to shareholders. Not that that's always a bad thing, but we're particularly interested in active management teams who are adapting to the changing environment and importantly have a good track record and a well-defined capital allocation model. And we would typically hold these shares through cycles. To be honest, if you look at a number of those counters that I've listed there on the right-hand side, they're not terribly cyclical businesses. We are value cognizant within this. So what we would tend to do is as shares within, you know, this particular pot push towards the top end of what we would regard as fair value, we would trim them And then obviously, as I think a good example at the moment to share we've been adding recently is Capitec, which has pulled back materially from its highs. That presents a really good opportunity for us to add to the position. And as I say, the aim would be to hold a core holding in these companies through time and essentially benefit from that compounding effect that they give you. And just at the top of that slide there, you can see roughly where we are in terms of weighting within our portfolio to these counters versus what you pick up naturally in terms of quality if you look at the broader market. So you can see that very clear bias, as I say, towards quality compounders. So certainly many of these shares, you would argue, are not necessarily cheap in the conventional sense, but we regard them as delivering a sufficiently superior compound return over time to justify that. If we look at the other side of the portfolio, this is where we're more active, and we would be looking for a whole host of opportunities. In fact, we spend most of our time, if I'm honest, looking at this area of the portfolio. We're also very careful, given that often they don't tick the quality box necessarily, to hold our hands to the fire to ensure that the thesis that we're looking for is playing out. And if not, we'll be very quick to exit these positions because we're mindful of the fact that, potentially these can do a lot of damage if they don't work out quite as expected. I've listed a couple of, themes that one might play from time to time. So certainly turnaround stories. We're always on the lookout for companies where new management are getting involved, often changing the narrative around how they manage capital, exiting underperforming businesses. And it's certainly possible that companies that go through a turnaround might ultimately end up in what we would regard as our quality bucket, where they become long-term core holdings. Cyclicals is obviously a big area in South Africa, given particularly the materials world. We would be looking for appropriate timing of when to be in those areas and out of them, because certainly when you get them right, you can make a tremendous amount of money. But these are, as one of my colleagues often puts, makes a point, these are areas where you date rather than marry. Value unlocks, there are a number of those that we've played successfully. And as I made the point earlier on, it's likely that these positions are going to be more frequently traded. I've listed on the right-hand side just a couple of themes that we're playing at the moment. We've recently been increasing our exposure as we've come out of COVID to SA private education. A number of those positions actually could end up being part of our long-term core holdings. What we've really done at the beginning of this year is shifted into what I've referred to as boring is beautiful. A number of areas of the South African market showing a lot of value, not terribly exciting in terms of long-term growth, but, earnings base is quite beaten up coming out of COVID with, lots of nuts in the cheek in terms of provisions raised and, essentially the ability to deliver reasonably decent earnings growth over the next couple of years with strong dividends, relatively independently of how the South African economy performs. More recently, having avoided this area for most of time, we started to build some exposure to the asset managers who have understandably been really hammered in this market sell-off. We've been quite cautious around mid and small caps. This is not really the time in the cycle for them. But where opportunities have presented themselves, we have a number of positions that we're very close to, which we think provide some really interesting optionality within the portfolio. So just, changing tack slightly to look at certainly how we dissect the South African market. This is certainly not how the JSE does it, but it's practically how we think of the South African market. And, essentially it conveniently splits roughly 25% materials. So that's certainly relative to international markets, a very high component of very cyclical stocks, which is a real uniqueness of South Africa. We have a roughly a quarter of our market exposed to rand hedges. Again, another uniqueness of our market is the degree to which many of the companies listed on our market are not that exposed to the SA macro story. And obviously that can be good and bad depending on where you are at any given point. And then roughly 50% of our market, which we would regard as the SA Inc. component, which is your direct exposure to our economy. So, you could say in a sense, half rand hedges, some better quality than others, and then half domestic plays. So when we look at how the fund is currently positioned, We're relatively neutral on the domestic side. There is a little bit of a difference between the point I made earlier about roughly half of the index being in domestics. Here you'll see that we're showing it as around 60%. The reason being that the domestics here includes all of the small caps, whereas the previous slide is more orientated to just the larger component of the market. So, most of the small cap component we've included in domestics here. So we're a little bit underweight domestics, and that's largely because many of the quality plays, and you'll recall from what I listed just now, tend to sit within that Rand hedge bias. So it's not really a big call that we're making on the Rand per se, but it just tends to be because of our orientation towards quality. Very difficult to call yourself a quality fund and be overweight materials. And certainly in a period where we have a rampant run in resources, that would be a likely time in which we would struggle, but we would be cognizant of that and tend to close that to some degree. You can see that we're underweight at the moment, less than we have been. And certainly we do buy in and acknowledge that the longer term kind of commodities cycle, we're certainly struggling a little bit at the moment, but there's a strong case to be made that we will see commodities resume their strength as we come out of this recent downturn. And then at the moment, we're sitting on a reasonable amount of cash. This is not really an active call. We've recently had some inflows into the fund. The intention is to keep this fund fully invested. And we have a number of ideas that we're busy enacting at the moment. So over time, you would expect that to diminish. And you can see our top 10 holdings. It's not a pure reflection of what the index looks like. We're much more of a bottom-up orientated house here. However, we are cognizant of the benchmark, and we are certainly aware of ensuring that we don't get completely out of line with the broader market. So if you could call it a sort of hybrid view in terms of how we approach it, but with the bias far more towards bottom-up stock selection. In terms of what would I regard as being the ideal market conditions for our particular strategy and our fund, gradual depreciation of the Rand, it goes without saying that's, certainly plays to the fact that we are more orientated to Rand hedges. We have quite a lot of exposure through the likes of Naspers and Richemont to China. And so certainly it hasn't worked terribly well recently, but we patiently wait for investor sentiment towards China to turn. And we've got our eyes firmly fixed on this upcoming conference in October, where potentially beyond that, a lot of uncertainty will be relieved. As far as, the domestic economy is concerned, what would be ideal for us? I call it baby bears porridge. We don't need rampantly strong domestic economic conditions. Yes, of course, that would be good. But it's under that scenario where I feel, frankly, that, you're not really rewarded for being a quality house. It's a tide that would lift all boats. So when things are relatively tough, which is exactly the environment that we're envisaging, we think that's where really quality gets rewarded. And you'll start to see these compounders and the better management teams begin to prevail. And obviously a big issue of debate at the moment is where's the broader world economy going? What's happening on the recession front? Are we going to see a severe one? I think most of the world is now sitting in the camp that we are going to see a recession. Certainly from our perspective, it would be better if that was a relatively mild one and one in which we retain a lot of tightness around particularly the energy complex, which is one of the bets that we've made. So just in conclusion, what does our performance look like? What we've shown here is just really the performance since this fund was launched as a unitized product. We've obviously had a lot longer experience in terms of running domestic equities. You can see that we had a fairly good period up until the beginning of 2022. We had a very difficult first quarter of 2022. And if you'll think back, that's the time when, resources went absolutely crazy. It was coincided with the time that the Rand rallied. It's probably the worst scenario for a fund such as ours. And certainly we struggled during that first quarter. But what's been really pleasing is the degree to which that is reversed now. We're starting to see, the reward coming through for consistent quality. And certainly my sense is that that is the environment that is going to prevail for the foreseeable future. So, I'm really excited in terms of how our fund is set up and positioned to start to really differentiate in terms of performance versus the broader market going forward. So just then, the last comment I'll make before I hand over to Nolan is that, really we are benchmark aware, but bottom-up focused in terms of our stock selection. I've made the point about that quality orientation. And, we would expect, frankly, over time, that quality compounding to be what really drives, does the heavy lifting in terms of relative outperformance. And we look to augment that by the nimble move in and out of opportunities that we're looking for on a constant basis. I'm going to leave it there. I'm going to be on the panel to take any questions you may have at the end. And, I look forward to hearing your feedback. So I'm going to hand over at this point to Nolan. Thank you very much.
Good afternoon, everyone. Thank you very much, Mike, and everybody. Thank you for dialing in just to listen to us. In terms of talking about the diversified series, the way I look at it is that using a song from my youth, I guess I'm actually just another brick in the wall. And really what I mean by that is that Nest drives the actual investment portfolio. Nest, being Simon and his team, they will decide which building blocks they want to use, of which, to be honest, Anchor is just one. And they will then give us very strict parameters as to how they would like us to actually behave within that building block, risk metrics, etc., that we have to comply with. And the quid pro quo is that we will feed up information back to Simon as to how the different asset classes are behaving, what we're seeing in the market, and over time that enables him to respond and manage the portfolio. So specifically looking at the fixed income building block that I'm responsible for, I figured it would be very boring if I sat here and talked about why I get very thrilled about an R213 versus R2032. So instead, I figured let's talk about the information that I'm feeding up to Simon and how that is playing out. So what I wanted to talk about is, starting on the left-hand side, you've got a graph which shows the, that's a bit of a driving error on my side. Let's go back a few. So you've got a graph on the left-hand side, and that shows the US dollar oil price. I got a new laptop, still learning to drive it. The US dollar oil price over time, and it's pretty much over the last year. And the point I want to make is that you can very clearly see the oil price coming down over here. And where we're at right now, in fact, is that depending on what oil you want to look at, Brent, West Texas, etc., you're going to see oil is circa $85 a barrel, far cry from the 120 we saw previously. But that's got a very profound effect. A year ago, we were looking at oil at 120, and it had gone from sort of $60, $70 to 120. 35-40% increase in the price of oil, and that was incredibly inflationary. Today we sit here, and oil a year ago was kind of $80. It's now $85. Actually, oil's up 8% year on year, and that's a very, very different discussion to when oil was up 40%, and that's going to have a very profound effect. And in fact, if you roll that forward and you sit and say, well, what's going to happen if the oil price stays around these levels, is by the time we get to about February, March next year, you're saying, oil was at $120 a barrel. It's now back down to $80 a barrel. Oil has actually decreased in price over that year by about 30%. So oil is about to swing very much from being inflationary to deflationary. And you see that in the Reserve Bank's numbers. So if you look at the Reserve Bank's inflation forecast, at the moment, South African core inflation is about 4.4%. And then what they do is they kind of add energy and food inflation, and that gets you to headline inflation, which is running at about 7.3%. And that addition for food and oil inflation next year actually becomes a subtraction. So if you look at the Reserve Bank's forecast for inflation next year, they've got core inflation pushing up to, I think it's 5.4%. And then headline inflation being that minus the deflationary effect of oil and food that's also going to have a similar effect. And you end up with inflation expectations of about 4.5% next year. So that's how we see things developing. And in fact, in the US, it's a similar sort of scenario where at the moment, core inflation is about 6.3%, headline inflation is at about 8%. And we see that headline inflation pulling down to 6%. And in fact, as inflation subsides more broadly in the USA, inflation is going to come down even further. So the graph on the right, if you look just at the blue line here, is over time, what Bloomberg does is it goes to economists and asks them to forecast inflation numbers, and you kind of see their inflation expectations. And these were the good old days when inflation was transitory, and then a while back, economists realized, whoops, we got that one wrong, and inflation expectations have risen. But by and large, we're right next to 2023, and the expectation is that 2023's inflation is going to be about 3.8% if you ask economists, or certainly US inflation. If you look at, if you ask me, it's probably a bit low, but the US inflation is going to be somewhere around about 4%. That's actually a very, very important number. And the reason it's important is that if I look at the US's rate hiking cycle, we are expecting to see another 0.75% in November, 0.5% maybe in December, maybe another 0.25% in January. But that puts the Fed funds rate at 4.5%. That means that with inflation at 4% for the first time in over a decade, in fact, almost 2 decades, you're going to have a situation where US cash has a positive real rate of return. That's a massive, massive shift for the market. It's a massive, massive shift for financial asset prices, and we need to adjust our thinking to that. What it means as well, though, is, a year ago, we had a lot of forecasts of where interest rates would be hiked to. Some guys thought it would be tiny hikes. Other guys had some pretty drastic numbers. But by and large, the more hawkish, the more sort of higher numbers, we're basically saying the US needs to hike until we get a real rate of return. They were right. We're going to get there. And we're going to get there by about January, February next year. That means that in all likelihood, it's been one heck of a journey, but we're getting to the end of the rate hiking cycle. So as the cycle shifts out of a rate hiking cycle into a period that's going to have interest rates high but stable for a long period of time, things change. How the markets behave changes, and we can actually look at history to see how that's going to play out. So when I chat to Simon, what I talk to him about is the fair value of the South African 10-year bond. And really what Anchor does is we say to get the fair value in an SA bond, you want to start by adding the fair value of, or the yield on the US bond, which is the dark blue band at the bottom. You add to that a risk premium for South Africa. And on top of that, you add then a currency differential for the fact that you're now investing in rand versus dollar, and you can, the cost of hedging that out. Add those three components together, and what you get to is where the fair value of a South African 10-year bond is. And what you can see is that line right up top is where the bond is actually traded. The model's been pretty good. In terms of what this model is saying to us right now, there are two things that we want to focus on. The first is that the blue line is above our model fair value. It says bonds in South Africa are maybe 0.5% cheap, and there's propensity for capital gains in the long run. The other fact I want to talk about is we're at a period of heightened negativity, heightened risk aversion. And that blue red bar in the middle has widened out quite significantly from its historic norms. If that goes back most of the way, halfway back to where it's historically been, and the bonds just sort of compress some of that cheapness, then there are significant capital gains to be had on bonds. What do I mean? I mean that if that all happens, it's the kind of year where bonds return 16 to 20%. And that certainly is plausible in the future, but not now. So what we're saying is at the moment, we think we're heading out of a sort of rising yield environment to a stable yield environment that makes fixed income quite attractive because you're going to be earning very attractive interest yields, both domestically and abroad for a while. And then sometime when the market calms down with regards and sees meaningful evidence of inflation coming down, sees meaningful evidence of companies surviving and beginning to grow again, that risk aversion disappears. And at that point in time, there's a significant capital kicker that will be available in bonds. So that's the message we're communicating to Mike or to Simon. And then Simon asks, what about the rand? And Anchor applies a PPP model, purchasing power parity model, to the rand. And that shows that over long periods of time, the rand appreciates against the dollar by the inflation differential. That's not holding particularly well right now. And what you've instead seen is an incredibly strong dollar this year, where the dollar has sort of run up to about 18 Rand to a dollar, potentially will go further. And that is a function of two things. Firstly, it is a function of the rate hiking cycle. Secondly, it is a function of most of the other developed markets are just looking as if they're in disarray right now, whether you're talking about the UK, whether you're talking about the Eurozone, even China. They've all got significant homegrown issues, and that's made the dollar almost the only game in town. Looking at the rate hiking cycle, though, and historically, when the US has sort of shifted from a hiking cycle to the end of the cycle where things plateau for a period, that's typically been around about the time that the dollar strength has also sort of at least come to a halt, stays there for a while, and then you have these long rundown periods like you can see in 2000 or 2002, where the Rand gradually claws its way back. So in terms of dollar strength, very realistically, we're talking about getting to the end of dollar strength sometime next year as well, probably late Q1, maybe Q2, if historic norms repeat themselves. So within all of that environment, looking at the shifting tides, what are we really saying to Simon? We're saying that, you know, it's been a bumpy ride all around, but we're getting towards the end of this part of the cycle. And now's the time to start thinking about where we want to be positioned for the next part of the cycle, accepting that there is going to be volatility for a while. But once we're through the hiking cycle from Q1, theoretically, the volatility starts to slow down, returns start to normalize, and that puts us in a position where the portfolios are better able to sort of capitalize on some of the opportunities we see. So from that perspective, we're actually quite a lot more positive in what we're saying to Simon. And with that, actually, I think it is a good time for me to end there and to hand over to Simon to explain in more detail how he sort of allocates and manages between the different managers.
Thank you so much, Nolan, and thank you all for the opportunity to present to you today. Let me go ahead and share the presentation over here. So just as a brief intro, I'm Simon Plooy. I'm from Nest Asset Management. I'm the CIO of Nest Asset Management, and we have created this product for Anchor Diversified, as a portfolio that is specifically designed to be heavily invested in Anchor funds, but also have other complementary managers to augment the portfolio and give a truly diversified portfolio to clients. And the approach we've taken here is what we're going to focus on today. You know, our approach of lead asset management in blending and combining strategies for clients in deriving the optimal solution for them. So we're going to mostly focus on the approach, and we'll have a bit of time on the track record. If there's a bit more time, then we can maybe look at the market positioning. But I think given the time constraints, we're going to stick to the approach and the track record. So our approach of lead asset management, really comes from a point of diversification. So I'm sure all of you have heard some analogy of diversification involving eggs and baskets, and that analogy normally works in most instances. But there's a trouble with it when we do fund management, and that is that a fund or a fund manager can buy the same stock. So just as Mike can go out and buy Capitec this morning, there's a whole bunch of other managers that can go and buy Capitec. And what it means is that multiple managers can occupy the same space. And that's not possible, with the analogy of a basket, because every egg in that basket is a distinct, unique object. So this overlapping that occurs between funds is a real problem in multi-management. So we like to think of our approach to diversification, or a better analogy is that of a ship that has to carry a large number of containers. And the goal is to spread the balance of these containers all over the ship such that balance is maintained and that there is no concentration in any particular part of the ship. And why we want that, is that if balance is not maintained, that the ship becomes vulnerable to big waves or to unexpected storms. In the worst case, your ship may sink. So it's quite critical that when managers make individual decisions in their portfolios, that there is somebody steering the ship to make sure that the overall balance of the portfolio is maintained. So to put that in a bit more practical terms, multi-management theory has got this beautiful picture where, and I'm referring to the graph on the left here, where you select 3 different managers, they all got a unique style, and they end up largely owning stocks that doesn't overlap. That's the nice theory that we get taught in investments. But in reality, and you end up with a portfolio that's quite diversified with very little overlap between the managers. But what happens in practice, and it's almost inevitable, is managers start to own similar stocks. This is in particular case in South Africa, where you've got a limited number of stocks listed in the JSE. And what you find is a fund that's overly concentrated in a few number of stocks, or worse, stocks that just simply overlapping each other, and you end up with a benchmark portfolio. So to restore that balance, you end up with a lot of problems. Firstly, it's costly because you have to sell out of one portfolio and buy into another portfolio, incurring a lot of trading costs. There's inefficiency in terms of being times in and out of the market. And obviously, it takes time away from more pertinent investment discussions. So what if we can find an approach that's not only aware of these inefficiencies, but we're also able to correct it? So we like to think that we find that approach in lead asset management. We like to call it ballast, and it allows us to dynamically rebalance the portfolio to achieve the true diversification that we seek. So how is this possible? How do we go about to achieve this balance in the portfolio? The lead asset manager, being Nest, manages a portion of the fund. So we either do it directly through some passive allocations or by shifting between asset classes. And sometimes we implement a hedge on the portfolio. Our most recent example is actually right now where we've implemented some hedges on the currency. And maybe we can spend a bit of time on that later. So whether it's a direct capital allocation or whether it is a hedge overlay on the portfolio, as lead asset manager, we get actively involved in dynamically managing the portfolio. We, of course, do this at no additional cost to the client, and it's very carefully managed within our own risk tolerances. So we're not trying to the main aim is to decrease the risk of the portfolio as opposed to anything else. The benefits here for clients is that it all happens within a single portfolio. It happens instantaneously and is applied across the portfolio. So no in and out of portfolios for clients, no capital gains tax, no all kinds of inefficiencies that might happen. And it also allows a very broad universe that we can allocate to. At our disposal is really, not only all the local investments, but a broad scale of international investments that we can also make. So our approach of ballast, we really try and aim to increase the diversification of the portfolio. So if we go back to our example of earlier, by introducing a ballast to the portfolio, we can shift our fund away from this concentrated and imbalanced portfolio and more towards a diversified and truly diversified and balanced portfolio for our clients. So as I was mentioning, one example would be the dollar at the moment. I'm sure all of you have followed the news the last couple of days, and granted the last few days has been all about the pound sterling, but we've seen the dollar at historic record highs. Economically, this is not sustainable. because the stronger the dollar becomes, the more expensive goods become for the rest of the world. So yes, Nolan referred to the oil price coming down in dollar terms, but for the rest of the world, it is still a very expensive commodity in terms of the base currencies, because all currencies have depreciated by between 20 and 30% against the dollar this year. So from a lead asset manager perspective, what we would be doing is asking ourselves, looking at the PPP model, engaging with our different managers, engaging with Mike, for example, on the rand hedge exposure, engaging with Nolan on his bond and currency exposure, but then also speak to the other managers that we have in the portfolio, which are there specifically to augment Nolan and Mike in their portfolios, and understand where we want the portfolio to be allocated in terms of the offshore allocation. And this is typically, depending on, let's say, take, for example, a growth portfolio, this would typically be between 30 and 45% offshore. So the portfolio still maintains a high diversification to offshore assets. But in this context, where a portfolio is extremely volatile, where a currency is volatile, so apologies for that, where the currency is extremely volatile, and where there's a lot of opportunity for the rand to significantly weaken in such a volatile environment. But also at the same time, we know that the dollar is completely overvalued and it could actually come completely the other way. So these extreme levels where we would step in and implement a hedge on the currency in order to protect the offshore assets against possible rand strength. So as an example of, has this worked, is this approach of adding a ballast to the portfolio, this approach of lead asset management, has it worked? We believe it certainly has, as we can be seen by the track record. This is now over 6 years, the since inception number is over 6 years old. And as you can see, over most periods, the portfolio has managed to outperform the category. This is the stable portfolio that fits into the CISA low equity category. We also have the moderate portfolio. And then lastly, we've got the growth portfolio. And as you can see, these portfolios have done very well through the cycle. We've got a bit of time, so let me maybe spend the last 5 minutes speaking about just a bit more detail on the investment philosophy. So from a multi-manager perspective, we believe that ultimately clients are rewarded for investing in the long term. But in order to achieve that long-term reward, they need four important elements. They need to be agile in their portfolios and be able to change with the times, as we've seen this last week. They need to be very aware of market cycles. Again, I'm going to refer you back to the dollar and, the tech cycle that just played out recently. Is where in the cycle is the portfolio, where in the cycle is the asset classes. And do you really want to be buying dollars, for example, at 18 Rand for $1? Is that the right time to go overweight offshore assets, or is that rather the time to be underweight offshore assets? And then obviously always to maintain as much diversification in the portfolio as possible. And lastly, is to keep the cost as low as possible. What's the most efficient and the most cost-effective way of implementing a rand hedge in the portfolio or protecting against dollar weakness? We look at different investment styles in the portfolio. I actually think Nolan is, not Nolan, Mike has spoken about his quality bias in the portfolio, and that's definitely been shown to work over time. But so we know that there's a value bias, there's a growth bias in portfolios, and we believe that in order to build a diversified portfolio, we need as many of those components as possible. So we would specifically, when we're combining Mike, look for a complementary manager in the Anchor Diversified portfolio. We would keep in mind Mike's quality bias, and then rather blend in with a manager that's got more of a value bias as opposed to another quality manager quality bias manager in the portfolio. And again, we're very aware of the cycles. So this is a cycle of evaluation of value versus growth managers over time. And you can see that for most part of it, there isn't a large discrepancy between the two. But there were points in the cycle, the dot-com bubble, at the end of the dot-com bubble, and then again now recently, where value was either deeply in favor or growth was deeply in favor. And one needs to be aware of this when we're allocating. When all the cards are stacked against value and people stop believing in it, but yet the valuation and the relative valuation is strongly in favor of a particular style, that's when we tend to go overweight that particular style, being very aware of the cycle. And then lastly, maybe just 1 or 2 slides on market views. We keep these macro factors in the back of our minds when we continue to allocate to underlying managers. So Nolan has spoken extensively about inflation. So we take that data point, that inflation is high, but we're probably looking towards the end of inflation, and we would translate that into does it have an effect on our portfolio, if any? And we're quite happy to say at any point a particular macro factor might have no impact, but we expect value to continue to outperform growth in the portfolio, and we would have a slight bias to that in the current environment. We see also that global risks in terms of recession is increasing, as Mike have highlighted it, and we would have a slightly lower allocation to global equities, although not necessarily lower offshore weighting, but it's lower weighting to global equities in an environment like this. Rates continues to rise, which will continue to put pressure on valuations, which is again, gives a preference for value companies. But then again, we also noted that China is busy reopening. They're coming out of a hard lockdown, and this could put positive pressure on commodity prices. So one has to keep that in the back of one's mind, and rather maintain, not move too strongly in a particular direction. But what we're actually seeing mostly is that South Africa has been sheltered from most of what's happened globally, and has held up remarkably well in this environment. And we therefore have a slight overweight to SA in this current environment. That's it from my side. Dale, I don't know if there's any questions.
Yeah. Thank you, Simon. It's always special when you roll out a doctorate of maths to a retail audience. So thank you for keeping it simple for people like me. So if I could ask everyone, please, if you have any questions, I see several people have raised your hands. So if I could just ask you to please put your questions into the Q&A, and if I could ask Nolan and Mike to switch their cameras on, and we will open up for some questions. Okay, Mr. Gresty, I assume this would be the first question for you. You mentioned Capitec in your portfolio. Results came out today. Market didn't react well. What's your view?
Thanks, Dale. Yeah, I thought as I was saying it, I thought to myself, crumbs, it's pretty topical that it's, with results out today. And to be honest, it's a share that up until recently we've been quite underweight. As much as we've acknowledged over time that it's been a quality counter. Pretty much since this particular fund was initiated, we felt that the valuation was a little bit stretched, and as a result of that, we had a small weighting in it. But certainly it has been under tremendous pressure since really since the trading update signaled that the result was likely to be a little bit below expectations. And we've actually used that as a welcome opportunity to add to the position and now move to a much fuller weight. So, certainly I think the market was very, after the trading update signaled there might be a little bit of weakness there. There was a lot of attention going to be paid here. And, I must say, I'm a little surprised that the market has treated it as harshly as it has. I suppose it is a signal that when you're a highly rated company, as this is, your margin for error is very small. Looking through the result, I think the one area of concern is that, the dividend was a bit below expectation. But, frankly, in terms of dividend plays, this is not the primary reason we own the share. what we are also seeing is that, there's been quite a big swing around in bad debts, but it's not signaling any major credit concerns. That's just because it was releasing bad debts last year. And the way that it provisions, there's what you would call a little bit of new business strain. So you've seen quite a nice acceleration in lending. They raise provisions pretty much up front as they initiate those loans, and then the revenue comes through in future periods. But it does mean when you accelerate lending, your bad debts charge rises a little bit. So, for us, this is a decade-long high teens compounder. And, we're pretty pleased to see an opportunity to get in here. We didn't think the results were terrible, but, it's presented us with a nice opportunity. And that's kind of the way we like to do this. We're not completely ignorant about valuations. And, around core positions, we'll be up weighting and down weighting as the market dictates. And, this has been an example of that.
Thank you, Mike. Simon, question for you. How do you keep track of the exposures of each underlying managers, and how do you know when the right time is to implement ballast?
Almost got caught out there with my mute button. Dale, we've got a bespoke system called Spice, in which we upload our underlying managers' portfolio holdings, and that allows us to immediately see, where their largest exposures are, how they are, positioned relative to the benchmark, and also how does the overall resulting portfolio look relative to the benchmark. So, for example, up to about 6 months ago, we had some small cap in the portfolio, and that was due to 2 to 3 years ago. That was not only a very attractive part of the market, but we were underweight. We didn't, given the valuation of that part of the market, there was not enough exposure in the portfolio. The investment has done very well over the 3 years, although it was a bumpy ride. COVID definitely didn't help, but it was a bumpy ride. And then as the valuation matured, we could see that we now had way too much small cap exposure relative to the benchmark, which we were comfortable, and we exited the position. So that's just a small example to show, how we can measure exactly where our portfolio is relative to the benchmark, due to our bespoke internal systems.
I'm not sure if this next one is for Nolan or Mike, so one of you can take it. What does the weaker dollar mean to US equity prices from a valuation perspective?
Mike, do you want to grab that one?
Yeah, I'm assuming the question is really what is well, at the moment we're grappling with the issue of what does a stronger dollar mean, for US equities, and but I'll answer the question as it's presented. I mean, should we see the dollar roll and start to weaken? I think that would remove a current anxiety that we've got. I mean, you have across the S&P 500 somewhere in the order of 30% of earnings coming from outside of the US. And, at the moment, the key thinking or key concern that investors have is that they feel as much as probably the impact of higher rates is now adequately reflected in the multiple that the market's trading on, what's not adequately captured at this point is the prospect for earnings downgrades. So, with the dollar as strong as it has been, there's a good case to be made that earnings expectations are too optimistic. So it does present a headwind. Should we see the dollar roll and weaken, I think that would remove, that would certainly remove quite a big headwind from an earnings perspective. By the same token, for our market, that would probably light a fire under resources and materials. So, the dollar rolling over and weakening, would be the signal we would think for a resumption in, potentially better times ahead for mining shares in South Africa.
Nolan, question for you. We've seen some interesting monetary and fiscal policy recently out of the UK. Can you give us your view on that?
Yeah, sure. So, what you're specifically talking about is obviously Liz Truss has taken over as PM. and her finance minister, exchequer, I think is what they call them, has come out with a budget that shocked the living socks off most market participants. In fact, some of the guys in the office this morning were quipping that the UK is almost behaving like an emerging market at the moment. But what we're really talking about is that there are a lot of pressure points on the UK. And the budget aims to do two things. Firstly, the budget is going to subsidize natural gas because of the massive natural gas price increases that we've seen through the Russian war. And that subsidy is going to be funded by the government. The second aspect of it, though, is that the UK has a bit of a business model sort of challenge in terms of growing its economy. And what they want to do is kickstart the growth by cutting taxes. So they're going to slash the top tax bracket. They're going to reduce other taxes in places. And basically, the whole idea was that by cutting taxes, you'll kind of become more competitive and you'll spur economic growth. Long and short of it, though, is by increasing spending and cutting taxes, the UK is going to run up a significant amount of debt very, very quickly. And it almost feels like they're kind of doubling down on this model of, cut taxes and hope that economic growth comes back. Frankly, the market doesn't believe them. And one of the reasons it doesn't believe them is I think it was in the 1970s, they actually tried something very similar. And inflation got out of control, rate hikes sort of followed, and the UK actually ended up at the IMF going for a bailout. But what we're seeing today kind of rhymes a lot with what they did then, and that is scaring the markets. The market has reacted extremely negatively, and it sort of sparked a sell-off of everything. So, over the last 10 days, we've seen a massive sell-off of global equities, global bonds, global everything. And that is kind of a big risk aversion reaction, knee-jerk reaction that was kind of ignited by this UK budget. It's almost unprecedented. We've had the US, we've had the IMF actually both come out and say to the UK, this is nuts, you can't do this because it's going to put you in significant financial jeopardy. But I see that Liz Truss came out and basically said, look, we've got to try something a bit dashing and daring at this point in time. So they feel like they're going to go ahead with this. The budget's actually formally announced on the 23rd of next month, of November actually. However, as they push down this line, it kind of feels like there are a lot of storm clouds over the UK right now that are all, sort of creating, individually you could manage it, but you've got this perfect storm of a number of different clouds, and that's going to put a lot of pressure on the UK for a while. And I think the markets reacted to that. So we've seen British bonds sell off significantly. Interestingly, the British government didn't like it, so they've now come in to try and sort of manipulate the market by buying back their bonds to sort of push a price down. Long and short of it, though, is that if we're saying a fair yield on a US bond is somewhere around 3.8%, which is where it is right now, a little bit of a risk premium for the UK of, 1%. A fair bond yield in the UK probably is 5%. So I think the move from 1.5% to 5% was very stark, but it's actually realistic. And that's something that they're going to need to digest over time, which is going to be problematic for a lot of pension funds. It'll be taking significant losses. So that's what happened. That's what sparked off a really miserable last 10 days in the market.
Simon, when considering style, do you refer to selecting an index or shares or funds following a particular style? It appears that specifically SA shares move from style to style during a particular cycle. Is it worth looking at style for long-term investment?
Thanks, Dale. Yeah, I think that's a very poignant question. So yes, it's absolutely true that stocks, in terms how we define styles, quality, value, momentum, growth, you can go through the whole list. Stocks tend to move all over the place, and that makes sense. A stock becomes completely missed and it becomes a value stock and it trades far below its fair value. The market recognizes it, builds up price momentum, and eventually becomes overvalued stock with high price momentum. So it's definitely true. So We definitely look in terms of it as long term. We found that the majority of fund managers have got their approach to investments. Mike spoke about these quality buyers, but although augments it with some valuation and being very cognizant of the cycle. But I think the one thing we've learned over time is that everybody's got their biases, everybody's got their areas in which they feel comfortable. I think one of my biggest frustrations is getting a value manager to hold the stock of just a bit longer than breaching the fair value on the model. That they would buy a stock cheap and then sell it as it exactly just reaches that same level. But at the same time, if that's how someone behaves, if you understand what their style is and how they will long-term behave, you can actually build a portfolio around that. So it is very much in terms of long-term styles and fund manager approaches, as opposed to short-term stock gyrations through the different classifications.
Thank you, Simon. Next question. I'm also going to put a little answer to this question before Simon answers. So, Simon, what is your freedom with regards to choices and decisions? What's the range that you have to use Anchor funds, and what other funds do you supplement Anchor with? So I'll start by saying that the mandate actually allows Simon to take the Anchor funds down to 0 if he feels strongly convicted. So certainly, with all client money, we always act responsibly first. So Simon, would you like to have a go at that?
Yeah. So as Dale said, there's no mandate requirement from these are Anchor branded funds and they're Anchor products. They also use the Anchor Manco BCI. But despite that, there is no mandate requirement that we have to have a minimum amount in the Anchor products. But there's the business side, which I hope I alleviated, but there's also the client expectation side. And I think when a client invests in this product, there is an expectation that they will get a minimum amount of Anchor, which I think is also right. So yes, it is theoretically possible that we could have 0 Anchor. We would have to lose a lot of confidence in the Anchor investment team for that to happen. And given the team that's there right now, I don't foresee that happening. But in theory, it's possible. So, and I think that independence that it creates is what gives the product its strength. So around at the moment, we've got between 30 and 40% allocated to Anchor, depending on the specific portfolio. Other managers that we use in the portfolios, we found that Klukas Gray works quite well with Anchor. Andrew Vincent from there. We've got some Perpetua in the portfolio. We've used Satrix for the passive investments. Complementary on the income side to Nolan, we found that Eric Nell from Terabinth works quite well. They've got very different approaches, and it's quite nice to hear them, viewing interest rates from quite different perspectives and have very different approaches, but both, giving you a very good quality income portfolio. So that's just some of the names that we are using in the portfolios.
Last question for today, and I'm going to ask all 3 panelists to answer this question, and I've got a funny feeling, and I wonder if the answers will be different. If SA is grey listed, what asset class will offer the best protection versus the best opportunity to benefit from the return point of view? Nolan, you want to start us off?
So I'm chuckling because next week we're publishing an article on this actually on the Anchor website. So watch this space. The article was not written by myself or anyone up here, but to steal some of our economists' thunder, the interpretation is obviously grey listing is bad because, well, I mean, it's obviously not good. The question is how bad, and probably not that bad. A lot of market participants who are looking at us as an emerging market have probably by now figured out that there is a corruption problem in South Africa. They've probably figured out that our courts are somewhat, well, ineffective, euphemistically putting. they've probably figured out that, we definitely do see a fair share of money laundering. So from, the grey listing is not necessarily going to, shock anyone as to, wow, I didn't see that one coming. And they've probably, as a consequence, sort of positioned for it. And we've seen a number of countries get grey listed, sort themselves out, come back, and it's had a minor impact, Mauritius. That being said, there are certain sectors that will find it a bit more onerous. The banking sector is going to see their cost of doing transactions offshore increase. As an asset manager, we're going to find it more challenging and costly to, manage money abroad, to invest money abroad. Doesn't mean we're not going to do it. It just means we're going to have to jump through an extra set of hoops. So from that perspective, I think, certain industries will slow down a bit. Is there anybody who's going to win through this? I battle to see it.
So Nolan, your answer is no asset class will have the best protection or best opportunity. Mike?
Thanks, Dale. Yeah, I'm glad Nolan went first. It's good to get his answer there. But, I've been engaging with a lot of the companies we invest in on this topic. And, I've got a fairly inconclusive answer on it, to be honest. I absolutely concur with Nolan that, if there is to be an eye of the storm here in terms of kind of frustration and cost of doing business, it's the financial sector that is likely to be most negatively impacted. But, in my discussions with them, by and large, the message coming back to me is it's kind of manageable. It's not going to materially change their business. And you've got to overlay that with where valuations are at the moment. And, certainly it's in terms of our boring is beautiful strategy, we are reasonably overweight banks at the moment because, earnings growth is coming through and ratings are really, really quite depressed. I would tend to be, if I think through this, I would tend to be, in terms of opportunity, assuming that just more sort of regulatory pressure on SA Inc. cannot be good. It maybe is another factor that moderately leans on the rand a little bit and, tends to support that rand hedge bias and those businesses that are not doing business in South Africa in terms of, at the margin, a little bit of, relative performance. But, one thing I've come to realize is that South African management teams are kind of grown used to dealing with adversity. This came through very strongly in the recent Morgan Stanley investor conference, where you get the opportunity to talk to a great many management teams, over the space of 4 or 5 days. It gives you, a really good feel for themes. And the big theme one of the themes that came out for me is, don't underestimate the skill of South Africa to navigate this. And hence, from a company operating performance, don't throw the baby out with the bathwater. But in terms of a straight answer, I would assume this is marginally negative for domestic SA, predominantly within the financial sector, and relatively more favorable for quality rand hedges, on the basis that, the rand, it's going to lean a little bit on the rand.
Simon?
I also want to emphasize Nolan's point that, a large part of that is in the price already, because this is not new, at least not to the regular market participants. And we tend to think of, whether it's the grey listing, whether it's the South Africa exiting the WIGB, that it's at that point that prices start to adjust. But, market prices and market behavior is adjusted way before that. And often you see the inverse happening after such an event. It's going to be very difficult for me to speculate on asset classes. We tend to take a longer term view and ask ourselves, especially also in this current environment, not where asset classes will be in the next week or the next month, but a year from now, will equities be higher or lower? That's the approach we tend to take. I think what I will say is that it will be more difficult for financial participants to do business. We've already had some frustration in terms of opening accounts for investing in foreign funds, and there's going to be an extra round of that. So in terms of being agile, it requires us to plan further ahead, have more options open for our clients. that, when the opportunity presents there, that we're not stifled by bureaucracy and red tape in order to get that implemented.
Thank you, everyone. I'm sorry we couldn't get to all the questions. We are 5 minutes over time. So everybody, thank you very much for your time. Thank you to our panelists, and we hope to see you at our next webinar. Thank you very much. Bye-bye.